also use the chat window to communicate as much as possible. Wonderful. Great to see so much of participation. So, I mean, till the time we wait for the session to start, those who have joined now, kind request, please feel free to type in a couple of cents about yourself, briefly introducing yourself, and you may also mention any particular topic that you would like us to take up in realm of today's discussion. Any topic, any particular query you have, you can put up in the chat window as well. We would be having a Q&A session, and we would be taking up all your questions, queries, and we would also try to tailor the webinar if possible according to your suggestions. So, I mean, please feel free. Sure. Thanks, Zahir. Thanks for your question. We would definitely try to take it up. Wonderful. We are seeing a lot of people are still joining in. In any case, we have about like 3-4 minutes to go live, and we might allow 1 or 2 extra minutes for people to join. So those who have joined later on, kind request, please feel free to type in a couple of cents about yourself, and maybe like again, I mean, any particular topic, or I mean, any area that you would like us to take upon in realm of today's discussion, anything specific, you can mention that in the chat window as well. So we would be happy actually to take it up. Thanks, Jatin. Others also, like again, you can type in a few cents about yourself, introducing yourself if you wish to, and then maybe like mention if you have any specific area of interest in realm of today's discussion, any topic that you would like us to take upon, please feel free to type in the chat window. We would be happy to take it up during the Q&A. And I mean, if required, we might try to tailor the session accordingly as well. So please feel free to mention that in the chat window, anything, any specific topic of discussion that, I mean, any particular area that you would like us to take upon during the webinar. People are still joining in. We will just allow maybe a couple of minutes more. People are still joining in, and then we will start the session. Yes, Meet, we are planning certificate courses in climate risk as well. We would maybe discuss that in a little bit more detail during the Q&A. Others also, I mean, till the time we are waiting for the participants and maybe just like allowing them 1 or 2 minutes more, you can please feel free to introduce yourself in a couple of sense, maybe mentioning about your background. And also you can actually ask any specific question, or you may mention some particular topic that you would like us to discuss. So first of all, a very, very warm welcome to all of you. Thanks for joining today's webinar on AI, machine learning, and data science application areas for climate risk. And this is in continuation of our webinar series, Deep Dives with IIQF experts. As you all know, we conduct this webinars regularly on various topics of related to our field of quantitative finance, risk management, valuation and pricing of derivatives, financial engineering, machine learning applications in finance, algorithmic trading, so on and so forth. And I mean, in today's topic, we would specifically be discussing about two very important areas or hot areas currently. One is, I mean, of course, AI and machine learning and data science applications, and particularly in areas of climate risk. Now, climate risk in the recent times has become a very hot area. And as with most important fields, machine learning is something which is not only machine learning, I mean, all AI based models, machine learning, data science, and again, all this is applied heavily in nowadays in the field of climate risk as well. So we would specifically discuss the areas where AI, ML, and data science is applied in climate risk. And to take you take us through the session, we have with us Sanjay. So Sanjay would be the speaker for the today. Sanjay is to just give his brief background. Sanjay has done his MBA in finance and his MSc in machine learning and artificial intelligence from Liverpool John Moores University, and also has a PG diploma in machine learning and AI from IIIT Bangalore. Currently, he is working as a director with UBS in the risk modeling and analytics team, also handling model risk management and control in the chief risk office function. Sanjay is a risk management and analytics professional with more than 15 years of mainstay experience in risk models and methodology space, encompassing Basel, Advanced AIRB, IFRS 9, IMM, and SSECR exposure, XVA, FRTB, and OTC derivative pricing, and other advanced modeling topics. So previously, he has worked with various foreign banks, Barclays, RBS, Citi, Credit Suisse, mostly in the risk advisory and risk consulting domain. He is also very passionate about imparting practical model understanding and insights, and has been a professional trainer for corporate and investment banks, His main teaching interest areas are credit and counterparty credit risk, market risk, stress testing, stochastic modeling, quantitative finance, and machine learning. So, and Sanjay has been our lead faculty for the machine learning for finance course, and of course, he teaches in our various financial engineering and quantitative finance programs as well. Right. So, I mean, and just before I hand over the session to Sanjay, briefly mentioning how we would go about in the webinar, though most of you have received the details in the instruction emails and messages earlier as well. But I mean, today's session would be about 1 hour, and that would be followed by the Q&A session. So during the Q&A, we would be taking up all the questions, queries that you put up in the chat window. So we would request you to, I mean, whatever questions, queries you have, please put up in the chat window, as the participation is quite large. So unfortunately, we would not be able to unmute you just to manage the proper flow of the session. But we would like the session to be as interactive as possible. So please feel free to type in your questions, queries in the chat window. We would be happy to take it up all during the Q&A session. Not only questions, queries, I mean, if you have any specific, any interest area or like any specific topic in realm of today's discussion that you would like us to take up, we would be happy to take that up as well. So please feel free to interact with us as much as possible. And uh, so hope to all have a very good session. All right. So just allow us a minute for Sanjay to start the session. Thank you.
Hey, hi Nitish.
Yes.
Am I
Hi,
audible?
Sanjay. Yeah, you are audible. I'm just making you the presenter. So please start the session.
Okay, yeah, perfect. Whether are you able to see my screen or the PPT which I'm
Yes,
sharing?
yes.
Yeah,
Yeah.
yeah. So thanks everyone, maybe for the today's exciting sessions, and this session is at the cusp of two very important and emerging topics. One is the climate risk in itself, which is no less daunting given the renewed focus, and the regulatory maybe force through which it is coming. That and most of the insurance companies, the financial institutions, systematically important banks and financial institutions have to comply with the the climate risk guidelines, and specifically the ESG modeling, environmental, social, and governance modeling framework. And in a way that in itself join forces with the disruptive power of AI, machine learning, and data science. So today we are going to maybe link these two topics and see what is the scope and potential of AI, machine learning, and data science within the realm of climate risk. And I know that most of the people on this call would not be well, conversant with the climate risk, because it's a very new thing, right? So I'll first introduce the climate risk itself, right? And then we will go about covering what machine learning is changing there, and how that the climate risk modeling landscape is being driven by the data driven models, which where we use AI, machine learning, and data science, right? So let me first of all get started with the climate risk modeling framework. So how I see it, in order to understand it well, we need to maybe wrap around some kind of a theoretical framework around the climate risk. So I wrapped around it a framework which is based on criticalities, severities, and eventualities, and vulnerabilities. What I mean by each is criticalities is identifying what are the risks and where are those risks, and how those risks are differentiated. Like in general, climate risk, how we could see it, with respect to specific risk which articulate or manifest the climate risk. That is the criticalities, identifying the critical risk drivers which create or which may be led to climate risk. The second part obviously is the severities and eventualities. Now once we have the climate risk factors or drivers identified, we would look at maybe how different banks and financial institutions go into quantifying the severities and eventualities. Severities means the intensity of that particular risk which has already been identified under criticalities, and eventuality means how frequently it is expected to happen, some kind of a likelihood or probability based measure where we draw some kind of a probability distribution, right, to see how frequently it is expected to happen, and what would be the intensity or severity of it when it happens, right? So this is under severities and eventualities. The third part is vulnerabilities. Now given that we have identified the climate risk drivers or factors under criticalities, we have measured or quantified the severities and eventualities of the hazard by which this is expected to occur or this will likely occur. We will talk about the vulnerabilities that conditional upon this happening, right, how banks could see their vulnerabilities, right? What are the vulnerabilities there, right? What is the systematic risk there? What is the idiosyncratic or business specific risk there? How to go about it, maybe mapping it to what are my business losses or unexpected losses of a business if the climate risk were to manifest, right? So let's talk about the first one, criticality. So generally the climate risk of as going by the academic and practitioner literature is classified into two broader risk categories. One is the physical risk, climate physical risk. The second one is the climate transition risk. Now the climate physical risk is all about the actual risk which concerns what kind of downscaled weather patterns, right, basically could create a potential loss in value in our asset base, right? So identifying downscale weather patterns, right? Suppose if you are a bank, right, you would have a real estate or your premises or properties or data centers lying at various locations geographically, right? You will identify those locations, especially where your headquarters are or where your data centers are, or maybe where your major operation or trading or maybe front office lies, right, you will clearly see that those locations and the assets within those locations are at risk. So asset identifying downscale weather patterns, and the in the context of asset at risk, which asset of a particular bank are at risk. So we will go about maybe identifying the location of the asset, the building quality and the materials of the asset, the structural strength of the asset, individual cost components of the asset. What would be my direct cost? What would be my indirect cost? If something will happen, what is the cost drivers there, right? So and these are generally from a granularity perspective, this data is also provided by third party vendors, right? Many of them now sprung up over last few maybe years, who provide data based on specific location, covering all the major locations in the world where financial institutions or banks are majorly headquarters, like maybe Zurich, Frankfurt, London, New York, right? Maybe Singapore or Hong Kong. It provides that data at a geography level, which could be a region, at a country level, at a city level, or maybe at a state level, which where up where we have our major asset concentrations, right? And we could get that particular data and see what is the uh, 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 downscale weather patterns which impact those particular locations and where our major set base is resides, right? So that is physical risk. We call it a physical risk because it uh, it really affects our physical presence or physical existence or physical assets, right? And uh, we will talk about this in the severities and eventualities, how it could be further categorized, right? Now the second aspect of the risk identification under criticalities is climate transition risk. Now there's a physical risk which could have some kind of a knock-on potential impact on our existence or our asset base. But there's a transition risk as well, that as world over the focus will switch to the climate risk topic and its remediation. There would be policy changes, there would be regulatory changes, right? Like many countries are declaring signing the international protocol on climate change, and they are signing the net zero policy by 2050, right? Or 2040. Now this 2040 or 2050 which the company has signed is a legal contract or some kind of a outward declaration to the world that by 2040 and 2050 I will be net zero by carbon emissions, right? There are certain countries which are progressing in their tax legislation or regulation, which where they are changing their tax incentive structure, right, to facilitate or force this transition, right? They're incentivizing those carbon neutral products and services, and to the manufacturers and producers of those carbon neutral products and services by giving tax breaks and some tax exemptions or some kind of tax moratorium, right? So all these kind of things are clubbed together in policy and regulatory changes which will enforce market behavior, right? The second aspect is the technological changes, that the development of electronic vehicles, e-vehicles, right? Now e-vehicles, whether it be e-vehicles or other electronic form or alternative uh, you know um, uh, way of uh, you know running our planet or running our transportation or running maybe our household, right? All these technology changes are also creating a kind of transition effects, right, along with policy and regulatory changes. Then the third one would be uh, the change in the market sentiment, right? So most of the investors are now aware that in order for the long term investment objective and the mandate given to them, right, by the sponsors, they should move away from those corporates or those kind of securities related to issuers which come from the specific issuers which are mainly lying in polluting industries like mining, metallurgy, oil and gas, right? uh, Even logistics, these heavy fossil and fuel burning industries. Most of the investors are trying to move away and transition over their investment from those kind of companies to the other kind of companies like renewable energy, or maybe solar energy or wind energy, or maybe alternative forms of energy, right? So they are buying bonds, equities, uh, commercial papers, certificate of deposits, all kind of instruments, right, of those companies which are in the space of environmental friendly, right, business model, right? So that switch, while that switch is happening, the investor market sentiment would follow some ESG investment norms, which is enforced by the capital market regulator, the likes of Security Exchange and Commission in US, or maybe SEBI in India. And so they will enforce some ESG norms, ESG investment norms. The capital market regulator of various jurisdiction, that will enforce some ESG norms for investing. And in the consumer market, people like you and me, consumers, are generally becoming growing more conscious day by day that we should cut down our air travel. We should maybe somehow restrain ourselves from consuming products and services those are generally more carbon footprint, have higher carbon footprints. So we would also change our maybe sentiment. There's a change in the consumer markets, there's a change in the investor market. So all of this club together will create a transition, which would be something like a radical transition, maybe over coming years, or maybe a staggered transition. But it would for sure transitioning of the entire business model and economics and financial world, from moving away from carbon footprinted economy to carbon neutral economy, right? So these kind of physical risk versus transition risk always are categorized differently. So transition risk is generally seen in medium to long term, while physical risk is generally seen in short to medium term risk. And physical risk is generally seen maybe as irrespective of whether the transition happens or not, it will always be there. Like there would be always be events, climate risk events, or weather perturbations, right? But transition risk is that uh, structurally the market, the economies, the financial world, the investment world is moving consciously from away from the carbon footprinted economy to carbon footprinted setup to carbon neutral setup, right? So then maybe moving on to severities and eventualities, you could see that most of the focus of maybe physical risk, and we define physical risk as the direct harm caused to our asset base, right, or any potential disruption to our supply chains or value chains across industry sectors, which will cause some potential losses. And this physical risk is the focus of the modeling and measurement in the immediate future, right? So most of the banks, most of the financial institutions, most of the actuaries within the insurance, general insurance companies, they are focusing on physical risk as of now. So the physical risk is first of all what exactly they are doing, what they are supposed to do, right? As part of the modeling framework, they are trying to build huge data mines of uh, distributions, which capture distributions of frequency and severity of weather related various weather related hazard events. What are those weather related Hazard means a kind of uh, uh, so it is an antonym of the word survival, right? So hazard means non-survival, that there are some events which could create the system, entire system to be demised, or to completely vanish. Some of the things will vanish if this hazard is not prevented. That's why these are called hazard events. So how hazard events are, further so these are further categorized. The physical risk is further categorized into acute physical risk and chronic physical risk. Some example of acute physical risk, which is very short term in nature, is riverine flooding, right? So most of the rivers, the rate at which they are flowing, right? And if there would be some kind of snow melting or extra rainfall, excessive rainfall, the river line would flood, right? The river line would flood, and river line flooding could cause some of the vulnerable frontiers, where like London city, or Singapore or Hong Kong or even Mumbai. All these cities are have some kind of a river or ocean, right? So river Rhine flooding is a very critical acute physical risk for those locations where there's a risk of river Rhine over flooding. The second aspect is surface flooding, which is distinctively different from riverine flooding. Riverine flooding is the flood in the rivers. Surface flooding is basically the change in the precipitation, right? And precipitation maybe could be excessive rainfall, excessive ice, excessive snow, right? Then there are increased wind speed, hurricanes, cyclones, storms, right? The wind effects, right? Uh, then there are high temperatures and heat waves. Then there are fire risk or wildfires, sorry, right? Then there are freeze thaw impacts, like some part of the countries freezing typically, right? To a very low temperatures, very highly negative temperatures, right? So then these are actual physical risks. Now the question is how actual physical risk is different from chronic physical risk. Is actual physical risk is very short term in nature, and you cannot possibly avert them. You can only uh, prevent them, have some mitigation, but you could not possibly avert them, right? However, chronic physical risk are those physical risks which could be averted, like long term shifts, like sea levels rising, right? Obviously sea levels and ocean levels are rising. High variability in precipitation, right? Obviously the precipitation will happen, right? The which could cause surface flooding, but over long term, we could contain the high variability of precipitation. Some droughts which could completely lead to degradation of soil and agriculture and farms, right? Some landslides which will be tectonic shifts in how the under plates, or plates under the earth surface are shifting, or maybe part of the fact that the ground, or the earth is not strong enough to hold various uh, mountains or hills onto it, right? So landslides are also happening. So all these factors are maybe the focus of most of the actuarial sciences in most of the banks, consulting firms and insurance companies. Now what are the vulnerabilities where it could hit us, it could harm us, where it could damage us, right? The vulnerabilities are that the main thing is the short to medium term. What really matters is acute physical risk, right? Which cannot be averted, and which could quickly manifest into uh, extreme catastrophic weather events in a very short span of time, right? uh, for example, a large hurricane or cyclone can damage your entire infrastructure. It could disrupt the entire supply chain. It could harm the local and regional economies. It could trigger huge financial losses if you are concentrated in that particular market, or that particular region, or that particular city, or whatever, right? So But how to quantify it, how to quantify the vulnerability? So what generally banks do, banks measure or quantify the potential exposure to these short-term acute physical risk events, right? In terms of their compounding effects, right? And what we generally measure is what would be the near-term losses, based on the fact that some of these acute physical risk is growing in frequency, is oftenly happening, and the severity as well. Every time it comes, it create more damages, or the that would be measured through maybe how many insurance claims are made when these happens, these acute physical risk happens, and what are the insurance claim from last time to this time, and every time it is growing, right? So in order to just quantify, right, what a modeler is nothing but, you know modeling without quantification is nothing but, just shooting in dark. So in the US itself, the disasters driven by such damages, which is adjusted for CPI inflation, right, increase from 519 billion over the period of 1980 to 1999, almost 20-year period. So it grossed up to the CPI adjusted disaster damages, grossed up to around 519 billion. And during the last recent decade, 2000 to 2019, you could see that it m- it 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 is threefold, right? So that is the severity of the climate risk, right? It is threefold, and the frequency has also been very oftenly. We see that these events happening here and there everywhere. But this threefold growth in from last to last decade, right, to the latest decade is a startling figure for anyone to get alarmed about, right? This we can't afford. It means that 1.5 trillion of the US GDP has just suffered these losses, right? So if US, if for country like developing countries where like India is 3 to 4 trillion economy, if this would happen, right, half of our GDP will be gone, right, in just a few years, right? And in last 5 years alone, recent data, right, the same CPI adjusted number in 5 years has grown to 600. So if I extrapolate this simply, right, it this is expected to even uh, at least growing at for next decade, it is expected to grow at a rate of 60%, right? Okay, so that is a worrisome figure, right? Nothing to be cheering about, right? So that's year on year 60 to 70%, increase in such costs or such severity is literally worrisome, and that's the reason why there's a call for transition risk, right? Now transition risk, in terms of banks and financial institution, is you know uh, frameworked, or maybe through some kind of transmission channels. So what I mean by transmission channels, these risk drivers, physical climate risk drivers, like maybe the acute physical risk or chronic physical risk, right, which relate to maybe some of the short term effects and long term effects, long term shifts. Short term effects are captured by acute physical risk, and long term shifts are captured by chronic physical risk. Now this is first of all, in order to do some modeling in a structured way, we follow some kind of a transmission channels. So transmission channels means that whether it is a microeconomic channel or macroeconomic channel, right, through which these risk will get transmitted to the actual business risk, where it is manifested in the actual business risk. Microeconomic channel means that for some specific firms or specific companies or corporates, right? Or specific sectors or industries, this is a risk. In general, it is not a systematic risk, right? Macroeconomic means that it is growing as a systematic risk. It would not be contained to few sectors or few industries or few firms within those sectors and industries. Rather, it would be very much broad based, impacting every damn thing out there. So that's the macroeconomic way. So sometimes, some of these risks, like a simple hurricane or cyclone or riverine flooding, right, in Thames, right, river, might, or hurricane in US, like Katrina, right? It would impact specific cities, specific metropolitan clusters, and specific sectors or specific industries which are predominantly present in those particular specific locations, right? So then we would first of all see, only primarily see the microeconomic as a transmission channel and identify the specific sectors and industries, the impacted businesses there, right? Macroeconomic means that like maybe some of these chronic long term, like the rise of sea levels, right, would impact everyone. It could make the entire country go under the water, right? Like today, the size of Singapore or the size of Mumbai is becoming small and small because as the sea level is rising, most of the land locks are getting under the water, right? So that is a macroeconomic risk which will chronically play over long term. It's a long term shift, right? uh, and how, following these transmission channels, so transmission channels are nothing but how maybe you first of all, from climate risk drivers, you try to link it up to some economic drivers, whether it is microeconomic drivers or macroeconomic drivers. Microeconomic means specific demand and supply at a micro level. Macroeconomic means aggregated demand and supply factors, right? uh, and then you link it back to the business risk, which is in the context of the financial institution, and specifically the systematically important financial institutions or banks, which could then specifically mean that financial risk and non-financial risk, right? And further, it could be also be seen as the first order impact, which is direct basis, that whether it would impact the firms directly, like their asset base directly, or it would impact their suppliers or supply chain, or their suppliers, distributors, or it will disrupt their supply chain. Why we are talking about the indirect basis, right? Because some of the firms, like for an example, a particular company like Blue Dart operate out of maybe US, right? Its main headquarters are in US. Its data center is in US, right? And but it is a logistic company which is present everywhere, right? Omnipresent. Now the point is this, that if this will happen, right? uh, no matter if US is impacted or not, right? But even the countries like India, China, where Blue Dart earn, or the emerging markets where Blue Dart earn most of its revenues, will, if that would be impacted, that would completely disrupt its operations or its supply chain, right? Or its value chain, right? So even if its third party suppliers or vendors would be impacted, then it will the business will cease to exist after some time, right? So that is the indirect basis, or the second order impact, as we call it, right, which is examined over here. So you could clearly see that in the figure below, which depicts which take a stylized example of flooding risk. And what flooding risk, which is an acute physical risk, what potential damages it causes to the data centers or data storage, right, owned by a particular business, where we could say that it is a direct basis, and we are talking about the financial and non-financial risk both, because there would be some loss of reputation or some kind of a legal risk involved when we lose the data, because the data doesn't belong to us. We have data of customers. If we lose it, right, due to some damage to our data centers, we would be sued in the law, and we would face a reputational risk as well, that we could not even prevent, even when we could saw it coming, right? So this is obviously an example of microeconomic uh, uh, transmission channel, where we are talking about the direct risk, the direct basis first order impact, and we are going to account for both financial risk and the non-financial risk, right? uh, and here we could see that the physical risk and the transition risk, which I stated on the previous slide, is highlighted as climate risk drivers. Then there are transmission channels, which clearly says that the microeconomic is specifically focused on the specific impact on businesses, households, maybe the supply chains, right, which we call business disruption, the assets, the capital expenditure due to transition. Now there's an element of a transition element as well, which where the annually every business has to do some capex to shift from a carbon footprint economy to a carbon neutral economy. Loss of income, property damage, and liability lawsuits, right? Macroeconomic talks about maybe in general, if such a risk would be there, right, what would be the impact on the mortality rate, right? What would be impact on the labor force supply and the productivity if huge heat waves and everything, these weather disruptions are there? What would be impact on the price uh, adjustment, like maybe because you need to change the policy, or there would be supply level shocks, right? There would be some structural reforms. What would be the price adjustment you have to do? What would be the socio-economic changes, like consumer preferences would change, or maybe the consumer unemployment would change, the migration would change, right, immigration would change, right, and capital depreciation. So all of these are basically the macroeconomic factors which are focused. Now you could see that how it is being manifested, how it is being translated into the business risk of a bank. So we further link it back to using some function. We link it back to the operation risk, credit risk, market risk, liquidity risk, underwriting risk. Credit risk, operation risk is obviously due to supply chain disruptions, or maybe some inadequate internal and external system which could have averted or risk mitigated such a risk, right? We don't have that particular system to identify such a risk coming, and that's why it's an operation risk. Credit risk is that many of the our counterparties and obligors, including businesses, corporates, institutions, households, will default, right? Their default risk will be high, right? Given a particular climate risk event. The debt inflation would be that the debt which the company the credit or the lending which the company provide will provide at a higher rate, right, to all those households and businesses. Collateral value adjustment, whatever we have taken, like any kind of residential real estate or commercial real estate or any kind of asset we have taken, as part of our lending or credit underwriting activities, that would undergo some kind of a haircut, and its value will go down and down and down, right? So we would have far lesser coverage on our loans and positions, right? Market risk, right? Owing to the interest rate, foreign exchange, equities, commodities, etc., etc., owing to the volatility in that would cause the prices of the financial instruments which are publicly traded to exhibit higher volatility, right? And the generally the financial asset value, which is the basis, the fundamental basis on which the various instruments and the securities are priced, will go down, right? Liquidity risk, potential need for higher liquidity, obviously refinancing risk, that most of the companies will not be able to refinance their existing debt, right? That's again a risk. Underwriting risk, high insurance premiums, insurance declines, right? And insurance renewals, refusals. So all these risks are underwriting risk, right? Now the non-financial risk maybe encompasses the production, the availability of goods and services, the price, market change in product demand and purchasing or consumer behavior, right? uh, casualty, which is the loss of property and livelihood, right? Casualty risk is the casualty insurance, or the what we call the hazard risk, right? Technology, risk, the viability and the reliability of certain technologies, the relationship, maybe certain interactions and conflicts, right? uh, and legal and regulatory, like fines, seizures, penalties, reduce ability to operation, constraint operation, like human, maybe physical, mental health issues, and reduce productivity. So all these are non-financial risks which we need to account for, and this is how we go about mapping it. Now, coming to the moot point, what uh, now this is about all about the climate risk and the ESG driven climate risk modeling, right? Now let's talk about what kind of classical models are already there, right, which are at helm as on date, and what are their misgivings or drawbacks or shortcomings, and how the machine learning, AI, and data science is filling those gaps, right? So the existing set of models broadly, which do the main heavyweight pulling for climate risk modeling, are called Earth System Models, ESMs, right? So generally they are termed as Earth System Models, and the idea in Earth System Models is somewhat maybe more related to how the physical processes are there, how ecological system works, right? So it incorporates some biogeochemical cycles. Biogeochemical cycles means that how the chemicals are transferred from living things, between living things and the environments, and the interaction with the climate system, right? So these biogeochemical reactions, right, create our existence on Earth, right? uh, like you won't be surprised that if there would not be any worms in our soil, right? uh, Forget about anything, the soil degradation is the biggest problem, right? And if there would not be any worms in our soil, the soil will degrade to such a level that you won't be able to produce any, even a single grain of wheat or barley, right, on that soil, because these worms create some kind of a chemical reactions in our soil which make it productive for any crop to be flourished on that particular soil. So similarly, photosynthesis, the process of photosynthesis, the process of biochemical reactions in the soil, the process of maybe how ocean interacts with the clouds, and clouds interacts with the rivers, right? All these kind of ecological biogeochemical cycles are covered, right? Now uh, so it talks about how precipitation happen, how condensation happen, how segmentation happens, how sedimentation happens, how all these basic processes and their interactions, right? And hence ESM models, this earth system models, are capable of doing future projections of earth climate risk, because if there would be any break, right, in any of the thing, like sea levels all of a sudden start rising, or many of the icebergs start melting, which cause the sea level rising, and the sea level rising will lead to coupled with high temperatures, will couple to more precipitation. More precipitation will lead to cloud formation. Cloud formation will lead to heavy rainfall, riverine floods. If it go beyond a certain level, threshold, it could cause your maybe the surface flooding, right? The surface flooding would cause the damage. So such kind of maybe simulations or connections could lead to different kind of paths, right? In the Monte Carlo simulation way, like you draw different paths where it could go wrong. You sample those paths where you would have huge kind of a cascading effect of these catastrophes on your economy, on your financial system, and on the various business systems, right? Or the business ecosystem, right? And this is done under various GSG greenhouse gas emission scenarios, like what would be the temperature, how the earth would warm up, like if the earth would warm up by 1 degree more or 2 degrees more, right? What could happen, right? So greenhouse effect, or maybe the depletion of ozone layer, if the earth will keep warming the way due to deforestation and pollution, as well as the depletion of ozone layer, and maybe its knock on impact on the GHG emissions, right? If this would happen, then the warmer the earth, right, the vegetation or the maybe forestation will die away, and it will create even more substantive impact. And with oceans boiling and ice melting and ocean level rising, and maybe all of this, the we are doomed, we are therefore our doomsday, right? So the ESM are built. What is this ESM? How this is mathematically built, right? So there are these processes, ecological processes, interactions or interplays, which drives the earth climate and weather conditions, are basically based on certain fundamental laws of fluid motion, right? Which are uh, some of the examples, or maybe one typical example is the Navier Stokes equations, which is the equation which tells you about the dynamics of speed, pressure, temperature, and density, of the density, which capture the dynamics of gases in the atmosphere and the water in the ocean, right? So this, using this Navier-Stokes equation, which sit as the core formulation of the model, right? We capture what is at what speed, or at what pressure, at what temperature, at what density the gases in the in a stratosphere, right? The lower layer of atmosphere, right, or toposphere, right, how they are interacting, and the water in the ocean, how it is interacting, right? And then there are certain other physiological processes where, like the vegetation cover, the green cover, right, over the land surface, which is approximated based on certain observation. Now the limitation of these ESM models, earth system models, is that uh, the the question there is, how good are these models at capturing the severity and frequency of the extreme events, right? uh, or maybe the abrupt changes, or capturing the tipping points or some cliff effects. Why we need that? Obviously we need that for acute physical risk, right? The acute physical risk, because we want to ascertain, right, if the frequency of such events will increase, or severity of these events will increase, right? What is the distribution talking to us? What is the future distribution looks like? And if the frequency is increasing, or the severity of these are going in one tail of the distribution, right, which is towards the extreme side, we should be alarmed. So these extreme events or abrupt changes in that particular distribution, to note, are not homoscadastic, it is heteroscadastic. That distribution is changing. I showed you that how preceding 2 decades clubbed together is different from just preceding 2 decades, and how the forthcoming decade, 2 decades, would be entirely different based on the compounded annual growth rate. So it means the distribution is heteroscadastic, it is changing by time, it is not homoscadastic, where we could literally talk about the historical distribution of, or frequency or severity of such events, and maybe extrapolate it to the future. The distribution is changing, obviously, right? So ESM the limitation of ESM is, the question is being asked that whether ESM is able to capture the severity and frequency of extreme events, abrupt changes and tipping points and cliff effects. The then it come out in quite open that ESM are theory based models. They are presumptive models. They take some presumption about the physiological processes, and they presume that they have some prior knowledge or some form knowledge of the underlying distribution, uh, which they use as governing principles and rules to build relationship among different processes and interactions, which drives the climate, the earth climate risk. Now the thing is that when you are building this ESM model is a classical model which is purely theory based, or some kind of, even before doing the modeling, some kind of theory was postulated or proposed, which was agreed that this is how ecological processes or physiological processes work, this is how they interact, this is how the different variables are distributed. They follow Poisson distribution or extreme value theory distribution like Gumbel distribution. So this is the hypothesized or assumed things based on historical evidence. But today, given the radical changes or radical shift, these historical distributions or empirical distribution do not hold anymore. They are heterogeneously changing. So there's no more homogeneity or the constant distribution over time. There's heterogeneity. The distribution are changing. It is becoming more fat-tailed, right? Hence, these models are doomed to fail. They're bound to fail, right? The second aspect is, obviously, as I told, under the ESM, that they makes approximations on the physiological processes like the vegetation or the green cover, right? What is the density of that based on certain observation on empirical data, but that is again an approximation, and that is not an exact science, right? These ESM models are subject to various uncertainties, which are due to non-linear interactions between various multifaceted or a high dimensional set of variables, right, which interact with each other in very uh, you know very confounding way, like uh, you know um, uh, in the under the scenario of crisis, under any crisis situation, many of these factors would have a compounding effect and they interact with each other, right, which present a lot of non-linearities, a lot of uh, covariances across these maybe various factors which tend to co-vary, and hence ESG models are doesn't capture that much those many non-linearities as much as what could potentially be captured by AIML model. Now coming to AIML models and the data science AIML way of driven modeling, right? First of all, this is a purely AIML, uh, the the within the realm of AIML and data science. It is purely data driven way of doing modeling, right? So it doesn't hypothesize a theory. It doesn't create a set of assumptions. It doesn't assume that there's some underlying distribution which is expected to follow the empirical distribution or historically observed distribution. It doesn't make any of those assumptions. It completely, in a freewheeling spirit, it completely allow data, the latest data, to talk about what is the underlying distribution based on how the data, recent data or the latest data is maybe changing. The distribution will also dynamically change. It allows the distribution to change. As soon as data will change, the distribution is bound to change. And the machine learning is a dynamic way of doing modeling which is purely driven by the data, right? That's why these are called data hungry monsters. The only challenge with machine learning is that in order to train machine learning models and for them to give some plausible outcome, you got to train them with a huge corpus of data, which is not which will grow in multifold as compared to the classical ESM models, right? So that's the challenge there, that's the daunting task there. But need not to worry, we have now moved far ahead in big data technologies, and in data mining techniques. So we would be able to do that, but right, there's still a challenge there, that you have to mine a lot of data, you have to use a lot of data, right? And this kind of data is purely in non-traditional form, like satellite pictures, like maybe some of the low orbiting satellite giving sensors or sensor images or some sensor signals about the climate observations, all of that, right? This would not be typically your the traditional data, which will always come in numerical form. Rather, it would come in pictures, images, signals, at different frequency. We need to and the machine learning models are naturally have are capable of handling such unconventional data, right? So that's where the machine learning model are more adept, right? These The other part is that uh, the machine learning can accelerate huge demand which is placed on numerical simulation or numerical computation. Obviously, climate risk as a topic requires so many simulations of different paths, right? Which even traditional Monte Carlo simulation sometimes would not be able to do justice to. So a path leading to another path, leading to another path. So multi even simulation within simulation within simulations, right? Sometimes you require very a typical kind of a high distributed computing or parallel computing architecture to perform those, and machine learning models by their architectural design are very well uh, their efficiency and efficacy is very much proven there, right? So what kind of machine learning models are we talking about? We are talking about deep learning neural networks, where which are heavily nowadays used in climate risk models. Not heavily means it is being experimented upon. Industry is still at the stage of proof of concept, right? They're still using ESM models in the production, but the deep learning neural networks are used as a proof of concept to identify and classify patterns from satellite imagery, such as cloud structures, ocean eddies, and crop quality, and also to do the weather forecast based on past records and physical balance equations, which we talk about, like the Navier-Stokes equation. So this is the way forward. And now I'll just quickly talk about the way forward, right? So this is the way forward. Now we have to move fast, right? There's a panic button already being pressed, right? uh, while the panic button obviously requires us to address the physical risk first, specifically the acute physical risk, and as well as in the medium term the chronic physical risk. uh, but also the panic button is also there when many of the IPCC level international protocol on climate change, the multilateralism pact or are coming to enforce such regulation across Europe or across Asia, or that will devise which countries will be on the sanction list if they would not abide, which countries will be seen in the negative list or whatever, right? Which will completely disregard or violate those norms, right? Which companies will be blacklisted or further penalized, or maybe if not blacklisted, they would be subject to higher taxation or maybe higher regulatory inspection if they would not uh, have a transition soon enough, right? So all these effects maybe need to be accounted for, but the major risk is the short to medium risk, medium term risk, which we need to avoid. So the ESM models on one hand, right, will act as a feeder models to AIML data driven models, right? Uh, and we would have something called a hybrid model where we would use the Earth sensory data, right? So this is how the industry is going. Earth sensory data and other climate risk observation from low orbiting satellites, right? Uh, which will go into the ESM model, the Earth system models, and the ESML models, which I'm calling, I have coined this term. This is not a standard term, but earth system machine learning models, right? So both these models will get the same data. They will the ESM model will feed into the ESML model, and then based on that, these the AI or machine learning will initially do the task of what were the disadvantage or demerits or limitation of the ESM model, like working specifically on non-linear relationships, right, within different variables, non-linear interactions within different variables, working specifically on freeing up some of the assumptions about the data distributions, making them from homogeneous to heterogeneous, right? Making freeing up the ESM model from some of the uncertainties which are maybe owing to the like maybe in the previous slide I pointed that there are some uncertainties in the ESM models which are basically due to the approximation as well as the nonlinear interaction between different variables, right? So all these things will can be all these limitation can be addressed and overcome by using the AI ML way of or data science way of doing things. Now data science where it plays. Now whatever you are getting out of these sensory data, the earth sensory data, in order to understand the distributional properties and the change in the distributional properties and the shift in the distributional properties, you need to apply data science, right? The data science will then maybe you do some statistical investigation into the data and the change in their distributions, the change in the means and standard deviations and maybe higher movements of that particular distribution as required, maybe what kind of distribution future distribution we should be looking at, right? So that kind of work would be done by data science, and once we are sure about that, okay, this is how dynamically our data is changing, right? How these climate risk factors or drivers are changing, we could then apply some machine learning technique like neural network or deep neural network on top of it, right, which will get the same feed of sensory data as the ESM models. So the ESM models could be used as a benchmark model to evaluate the performance of the AIML models, which I am calling ASML, right? ESML, the earth system machine learning models. And then eventually we the only challenge with the AIML models in other areas like credit risk, counterparty credit risk, market risk, operation risk, firm-wide risk, stress testing, is that they are difficult to explain. But there's a lot of research in that area as well, which is taking wings from the fact that there are a lot of approaches which came up like Shapley values or game theory to explain the output of AIML models and making them more transparent to regulators, investors, auditors. So that is explainable. AI is also making AIML models more acceptable by various stakeholders, be it policymakers, regulators, auditors, right? Your investors, and so driven by the acceptability, the wider acceptability of AIML models and the potential which AIML model present for overcoming the limitation of the ESM classical ESM models. Personally foresee that in next 5 years, we would soon rapidly be switching from ESM model to the AIML model way of doing the the environmental or climate risk modeling, right? So I'll rest there, maybe and maybe let maybe people ask questions, because this is quite a wider topic, and maybe I just try to cover the length and breadth there, but obviously you would have specific questions in mind, and then I'll hand it over to Nitish to get into the Q&A session.
Yes, absolutely. I mean, first of all, thanks for the engrossing information. Actually, it was quite a bit, and I hope or everyone found it useful. So we will go into the Q&A session, but before going into the Q&A, maybe I'll just give a brief of like what we are doing in this field and how people can use our resources to maybe build a career in all these areas. I mean, I'm not talking specifically of only credit risk. I'm talking in general as well, right? So I will not take much time. Maybe like quick 2 minutes recap on what we have been doing over this last 1.5 decade. So as by this time, most of you might know, and those who are new to this webinar series, first time joining us, I mean, I represent Indian Institute of Quantitative Finance, and we are a body which is into education and training in the field of quantitative finance, financial engineering, risk management, quantitative algorithmic trading, and artificial intelligence and machine learning areas in finance. And we were founded by pioneers and top experts from the field of financial risk management, financial engineering, and investment banking. So, I mean, for people who have interest in making a career in all this domain, we have specific certificate programs which they can utilize to have a deep understanding of this field and specifically to prepare themselves and join the particular fields. If somebody is interested in the area of understanding of machine learning in finance, right? So we have a specific course of 8 months currently, which teaches machine learning and data science in context of applications in finance. So unlike majority of machine learning and data science courses which are taught in general, right? So we have brought a special course which teaches machine learning applications in context of finance, right? So and then I mean, people who are interested in making a career in the quant analytics, risk management, or financial engineering domain. So we have a couple of courses there as well. A 6 months comprehensive course called Certificate Program in Quantitative Finance and Risk Management, where we deep dive into both theory and practical modeling for derivative valuation and risk management. And then we have a program called Certificate Program in Financial Engineering, a course in the same field, but which goes more deeper into the mathematical modeling aspects, right? A course of 7 months teaching both theory and practical mathematical modeling for derivative valuation and risk management. And people who want to understand specifically about algorithmic trading, we have a couple of courses in that as well. So end-to-end teaching all aspects of algo trading using different kinds of strategies, technical analysis, price action, machine learning, and quant models. And given that today's webinar is also very specific to climate risk, the good news is that we are planning things on climate risk as courses. So we would be having specific courses in climate risk going forward. I mean, it would be announced very soon. So if somebody is interested understanding more about climate risk and its applications in the banking industry, we'll be coming up with specific courses in that. And in fact, that would be something which would be included in the quantitative finance and risk management course as well. Right. So, I mean, somebody has asked a question also about like what we are planning to do in climate risk. So, yeah, I mean, that is to your answer. We are definitely planning to do specific courses in climate risk as well going forward. So, we will intimate all of you all once we have announced it formally. And of course, you will be seeing that in our website and other platforms as well. So, I mean, not going deep into the courses today, that just like again, maybe just to mention, I mean, it's not like our courses is not only to teach you about the aspects, but it's actually to prepare you for the specific roles which each course intends to teach. And I mean, in fact, we do have a strong placement support system as well, which starts absolute from the beginning. Once you get in touch with us, we start with the career counseling, understanding your background requirements, suggesting the right course, right path. And then, of course, during the course, post the course, we have career mentorship by industry experts. In fact, the faculties are all leaders from the industry. I mean, we do have a dedicated support system on placement, the support team for that, with strong network of industry association, and we mean in the entire process of resume building, profile improvement, and placing your resume, right? So it's not only the courses to teach, but again, these are job oriented programs where we help with job support as well, right? I mean, yeah, there are a lot of I mean thoughts that our past students have shared. There are a lot of many of them are senior professionals themselves. You can go to our website and look at the thoughts that they have shared, how they have utilized these courses to build their careers in the quant risk management, machine learning, algorithmic trading industry. So here are just a few of them. Anyway, like not going deep into that, you can always go to our website and go to the testimonial pages to look at that. Just to give you an idea how you can also utilize these courses, right? So I mean, all these courses will target jobs in hedge funds, investment banks like Goldman Sachs, Morgan Stanley, or banks like JP Morgan and Citibank, stock exchanges, NISC, NSC, consulting firms like EY, Deloitte, etc. And of course, even the IT companies as well, because they also cater to a lot of the BFSI domain. So companies like Accenture, companies and TCS, etc. Right? I mean, the industry association has been pretty strong. This is just a very small list of, I mean, companies which we have worked with, I mean, as their consultants, trainers. I mean, the placement anyway, the team that coordinates with them, right? So this is just a small list of organizations. Our endeavor has been to promote the quant field in India for last 1.5 decades, as I was mentioning, and of course, who better than like making this field known to students? So we work with the leading educational institutions as well, conducting a lot of workshops and I mean contests like Quantathon and all that. So to promote this field among the students as well. These are just a small list of people. I mean, or the institutes which we have worked with, and so all that, right? So essentially, anybody who gets interested in knowing more about any of this course, or like even not only courses, like if you have any questions, queries regarding the field, you want broader guidance, you can call us and we'll be happy to discuss not only about the courses, but in the field in general. I mean, how you, I mean, based on your background, how you can enter this field. If you're already working, how you can go further and all that. So any guidance, any discussions you want, I mean, you can always contact us on this numbers, right? So now going to the questions, actually, we have quite a few. So let me collect the questions one by one. All right. So let's start with a question from Anil Garje, and he has asked. His question is that how machine learning can collaborate with geoinformatics. Do you want to answer this question, Sanjay?
Yep, definitely. So, Anil, geoinformatics is an area of information science on the geological or maybe geosatellite data, right? So that's why we call it informatics, and that is a part of data science, right? Essentially, it is nothing but data science, some kind of a statistics performed on the geostatistical geosatellite information, right? But machine learning, once you have those data set prepared, right, some kind of a data visualization done, exploratory data analysis done on that particular data, produce some informatics out of it or insights out of it, uh, it will further inform some decision making on what kind of models to be built, and which could pave the way of machine learning, because naturally speaking the experience has been so that this kind of data could not be handled by traditional or conventional models like the earth system models, right? And we are getting a lot of video satellite or images or image data, video data, signal data, some kind of a radio frequency data, all these kind of things, right? Once it is analyzed properly and thoroughly, by some informatics, or which is called data science, which is a branch of data science rather, right? we could then maybe get more understanding whether we should build some deep neural network or some kind of a transfer learning model, or some kind of ensemble learning technique. What kind of technique we will essentially go about, or convolutional neural network, what kind of technique we will apply for modeling various components of climate risk.
Right. Wonderful. So I hope that answers your question. Next question is from Zahir. And Zahir mentions that is working as manager IT for Watershed Organization Trust, which is WOTR, non-profit organization based in Pune, working in the fields of water and land management, agriculture, health, women, and so any application that you would like to mention is in his area. Actually, that was his question.
So I think, what was the name? Sorry, maybe
Zahid.
Zaid. Right. Your question is quite valid, because some of these energies, as well as utility companies, right? They are on the radar, right? If you draw a heat map to identify which industries and sectors are impacted by acute risk, right? Obviously, the utilities, the water management, and these kind of companies will come on top, besides energy companies, right? Energy sector, these will come on the top. So energy, transportation, and utilities, these are major sectors and industries where such thing called climate risk is the driving force of changing, switching business model or rebooting business model, right? So the specifically quantitatively, I could only say that the in water management, or even that is applicable to waste management or water management or other aspects of it, the climate risk modeling would give us clear indication what is the level of how the water level is depleting in the earth, right, due to climate effects, right? Whether what is the level of contamination of water in the rivers, right? uh, Whether we would have drinkable water at all or not, how to prevent diseases from such water, right? uh, right, what are the potential uh, effects on the personal health of the water which is going into the households, right? The other aspect is that how to create some rain harvesting initiatives, right? Right, where all to put those plants, right? Because there would be certain areas where we would expect, given the climate risk, would be we expect heavy rains, the other areas which dry up, right? So how to move the do the water restoration by initiating these rain harvesting projects in specific locations where we generally expect to have very high rains, right? Or same is goes for wind energy, like where to put the windmills and all, right? So all these aspects will be informed by quantitatively using the data, right? And in India, by the way, whether you note or not, in recent times there's a lot of development which has happened to capture this data. So now we are not lagging behind these developed countries, right? We have all these data lying in some vendor systems, and we need is to just mine that data and build some model for
Right.
for these specific purposes, right?
Absolutely. Right. So hope that answers your question. Any follow-up you can ask. The next question is from Antara, and she is pursuing her master's in environmental sciences. And some of the question, part as you have already probably answered, but again, her specific question is, what is the significance of GIS and RS with AI support to mitigate or analyze climate risks? Would you like to answer that question? Anything more do you want to add on that?
Yeah. So maybe somebody who is having a degree or pursuing a degree or is an aspirant of environment and climate risk. He has more to teach me on that domain, frankly, right? Right. So I know the modeling aspects, I know the AIML aspects, I know from my experience or on such use cases how this is being applied to the climate risk modeling. But your specific question, can you repeat maybe GIS, the impact of GIS and
Yeah, yeah, of course. The
uh,
question is like, what is the significance of GIS and RS with AI support to mitigate or analyze climate risks?
can you disambiguate these terms? I think these are some standards, right? Because
So,
I
yeah, yeah,
yeah.
Antara, if you are able to hear, then again, if you can expand the abbreviations that you have used, probably these are specific terms that are used in your industry. So it would be really helpful if you can expand that question a little bit more. We'll be waiting for your response. In the meantime, let me take up like the next questions. We'll come back to Antara's question again. All right. So the next question is from Vinith, and he has asked a specific question again. So first of all, he has said, thank you for the wonderful lecture. Thanks, Vinith. Great to know that you have liked the session. So he has completed his master's in environmental engineering from IIT Madras last year, and he worked on the special variation of rainfall due to urbanization of Chennai.
Mhm,
He has experience working with climate data sets and WRF modeling.
mhm.
Currently, he's working as data scientist for the last 11 months, and his specific question is if he wants to make a shift toward the climate risk domain, what kind of upskilling I should carry on? Having SGR GARP certificate would help me crack such roles. So yeah, that's his question.
Look, GAP certificate, similar on the footing of how FRM came, right, is a proxy for those who, like, even including, I would not have, with all due honesty, even including myself, who want to aware themselves with the terminology of climate risk. Having said that, you already have a degree, master degree from IIT Madras. I think you are already well versed with the subject and the terminology, right? Uh, the second aspect is that you need to, since you have a degree which is from a premier IIT institute, what people would expect for you to flourish in career is that you would know more quantitative aspects, modeling aspects, like how to do climate risk modeling using machine learning or AI or data science, right? That would be a very you know uh, uh, you know very good what you call maybe buffet of skills which you could bring, and that would take you for decades to come, right? You are already labeled as data scientist or machine learning, you're working in similar role family, but the future lies in marrying these two, right? So the conjoined effect of somebody knows climate risk, somebody knows AIML models very well, and its application to climate risk would be a unique competitive advantage, because there are very few people in that area, right? And that is the thirst of where the industry is going, right, across financial sector and non-financial sector as well. Yeah. So pursue
Yeah,
something in AI, ML, and data science, where you could get well versed on the methodology, mathematics, and the implementation of these AI, ML model on huge data set, including the climate risk data set, right?
right. Wonderful. I hope that helps, Vinith. So the next question is from, he has not mentioned his full name, he has mentioned his YJ. Anyway, so his question is, climate risk can come as an issue to country as well. How can a data analyst contribute in this field and from where? Some aspects of it you have already discussed, but if you can add something to that.
Yeah, so at a country level or sovereign level, or even for that matter, many supranationals, right? Supranationals, I mean World Bank or maybe IMF, right? Or even United Nations or WHO, right? They are also working on the climate risk data, but they are working at a country risk level, right? So the scorecard which is uh, formed is not at an industry or sector level, rather it is at a country level, right? And then the data set will be a bit different. I would not say different in its nature, but differently processed, like differently the transformation or the mapping of data would be a slightly different. Like if India is heavily dependent of on agrarian economy, it is far lesser dependent on manufacturing economy, right? Or far more on agrarian and service economy, then so be it. That will factor into the data to calculate the, you know, India's you know, country risk from a climate risk perspective. Some countries are purely driven by the tourism, travel and tourism industries, and there the impact, the incidence of the impact would be high. So it would be driven by some kind of aggregation effect across different sectors or industries, and how they contribute to the GDP or GVA of that particular country or economy, right? So it would be very country specific topic. No country, no two countries would be similar on a particular scale. They would have different sectors or industries contributing more or less to their economy, and how those sectors or industries are getting impacted by climate risk then would determine what would be the volatility or the climate risk vulnerabilities that country has, right?
Right. Absolutely. I hope that answers your question. Next question is from Sri Chitra, and she is a research scholar, Department of Geology, University of Calicut. The question is, what are the freely available softwares or websites which can use for climate studies specifically? Anything you can help her with?
Yeah, so generally the data from IMF is, I think, publicly available, right? The EBA stress test data, right, or EBA stress testing paper for climate risk is the market norm, because as on date, the formalization of regulation first came from EBA in terms of climate risk, and they have specifically mapped the different risks to different manifestation of business risk, right? So that mapping could be deduced from the European Banking Authority data, ECB data, European Banking Commission, or so. And the other aspect is that the stress testing the stress testing of various playbooks or portfolios or positions within those portfolios is generally driven by the EBA, European Banking Authority stress testing for climate risk, right? Climate and sustainability risk. So these are some of the data. And in terms of tools, frankly speaking, I'm not well aware of any tool which is freely available, because any which way, this is not a long back topic. It's circle back to maybe few years back when it all started. And even banks are even themselves far away, or third party vendors are themselves far away from building a model which they could present for free use, or open use. So there's no open source thing here, right? But you could definitely, in Python, you could the some of the data is available. You could pick up that data, start analyzing as a data scientist, and even you could write a research paper. If you know a bit about data science, you could write a research paper, and that is a hot area to get engaged, right?
Right. So see, as a follow-up questions, I mean, when it comes to in terms of machine learning and AI, anything you would like to add in terms of data sources, or like it would be same to look at?
I have few papers where some of the links to data is shared, right? Like the Indian Met Department data or any Met Department data, you could build a time series of that data, right? You could do at least that, and that is also very useful in the given context. In the current context, you could use a met department data, you could build a time series, you could use something like a sequential learning, either a neural network or some kind of other model, like a reinforcement learning model there to further do the forecasting task, right? So many papers have used the recurrent neural network and long short term memory networks to do the time series modeling of met department data, right? And that could be done, right? Obviously, and that is a low hanging fruit to for you to at least understand the area well and the landscape well. Yeah.
Right, absolutely. Okay, so Subhas has mentioned, very good session, sir. Nice lecture and presentation. Thanks so much, Subhas. Thanks for your kind words, and great to know that you liked the session. Uh, Next question is from Ankit, and I think that's a question for me. Is the courses conducted by regular staff or IIQF through external faculty? So Ankit, whether it's regular stuff or like the external faculties, what we always ensure is that all the courses that we teach are taught by leaders from the industry. Majorly, these are people who are uh, working with international banks or other leading financial institutions, particularly in the actual modeling space. So, I mean, if they're teaching the quant modeling, they would be themselves a quant modeler. If they're teaching machine learning, they would be machine learning expert. And particularly, who is day in, day out actually dealing with the modeling aspect. Either they are themselves in the modeling, doing the modeling, or like leading modeling teams, right? And if there's somebody who is an academic, I mean, yeah, there are a few topics which are taught by certain academics as well, but these are the leading researchers in that particular field in the country, right? So whoever comes to teach, whether it's like an internal or external faculty, the primary thing is that they would be a leader from the industry perspective, or a leading researcher from the country, right? I mean, if you wish to discuss in more detail, I'll be happy to discuss one-on-one. And but like for the time being, let's go to the next question. So Zahir's questions: what kind of open data sets available for climate risk analysis? So I think we have taken up that question already. Okay, let's going to the next question is from Suman Lata. So our question is, uh, she's a research scholar and CEO of Integral Development Foundation, currently working on WASH, water, sanitation and hygiene issues, climate change and socio-economic development in Kanpur and nearest district. I'm also working on social enterprises that are working upon waste management and organic agri products. What she wants to know is there any mentoring and evaluation tool or application to monitor this social enterprises, financial and other social development? Would you have some idea, or like would you like to throw some light on that?
Okay. Yeah. So, yes, Lata. So, I suppose nowadays, what is happening, a scorecard or a metric is created, evaluation matrix is created, which will rate many of the social initiatives themselves in terms of what they are trying to achieve, and that too quantitatively, not qualitatively. Obviously, you are already the experts, and your firm is expert in doing qualitative assessment, but quantitative assessment, right? Like whatever earlier projects they have done, if you want to fund them or if you want to partner with them, how you could go about assessing the progress and the success of those particular projects, right? What kind of soil restoration or they have achieved, what kind of maybe land acres they have revived for agriculture economy, right? What is maybe the green cover they have created to restore the soil, how they have rotated the soil use for different crops, or what kind of yield it has created over the years. So some of the quantitative if there would be a data, right, we could build quantitative models and some kind of a data science driven insights and informatics to drive the firm's strategy in the right direction, right?
Right.
Which means that whom to partner with, whom to fund, right? How to assess project, how to take investment decision for various allocation of investments to different projects, right? All of that is nowadays in a professional organization is done more quantitatively. Yeah.
Correct. Yes, I hope that answers your question. I mean, if you have a follow-up question, please feel free to put it up. The next question is from Bukola, and he asks, are there any specific climate risk models, names of such models? And I mean, if you can name such some models in risk management for specific climate risk.
Yeah, so the one I come across was named as let me maybe quickly search it, right? There are few names which are there. Just allow me a moment, right? There's an AI model, right? I want to tell to those who ask the question of open AI. Where is it? Just give me a sec. Maybe I'll brought it up
Sure.
somewhere, right? This model, right? What is the name of the model? Anyway, I don't maybe remember where I saw it. There are few models which I clearly saw. The names were mentioned, right? Uh, hmm.
That's fine. I mean, I think I mean we can specifically message him the names later on. I mean, if you wish to.
Yeah. So I'll take back that question, and maybe even for data sources and which are readily available and used in climate risk modeling, as well as name of some models, right? I'll get back to you. Yeah. I'll maybe include in the circulated deck, which I think you will get after the the session, which we covered during the session. Yeah.
Sure, sure. That works. That works. It's a new field, and we can understand. And with a lot of research is still going on, so please feel free. I mean, you add in the deck, and we'll circulate it with all the participants.
Yep.
All right. So there's a question from Meet. The next question is so he asks, can you please let him know how climate risk modeling would help someone in credit risk modeling domain. So that's a question. So
Look, the balance sheet of the banks, suppose hypothetically a bank has 500 billion RWA balance sheet, right? Uh, 60 to 70, rather 70% of that, right, means 350 billion would be in credit risk, right? And the acute physical acute risk which we talked about is more related to the default of the counterparty, the actual default of the counterparty, or the because their businesses or supply chains have been disrupted, they have got a direct damage to their asset base or physical assets, blah blah blah, right? So the credit risk in itself is changing, like the credit risk rating model or the credit risk scorecards is in itself is embedded with the climate risk factors or climate risk variables. So nowadays that is a task which personally we are doing as a bank and others are doing as bank, how to embed the climate risk factors or variables into their credit risk models, right? So all these ESG factors or environmental social governance factors specifically focus on climate risk factors, environmental factors are already embedded, which calculate at a counterparty obligor or transaction, or maybe at a particular position level, what is the climate risk which that position or counterparty or obligor is subject to calculate default risk or recovery risk or other aspects of modeling, loss risk and all. Yeah.
Absolutely. All right. So again, there's a follow-up question from Zahir, and he has asked, can we use automatic weather stations data to analyze climate risk?
Yeah, obviously, because the first thing is, in order to, so that is a specific topic of acute risk, because you have to see the uh, uh, downside weather conditions, which will be in the short term, right? And that is the current focus of the industry as well, right? How to use this weather met department data, right? How to try to forecast the next weather, the volatility in weather, or the next event in weather, right? And using some poison distribution or some kind of a event modeling distribution, you could obviously do that. That is the first thing, natural thing to do right there.
Right. Absolutely. So going to the next question, so Antara has sent a follow-up. Yes, he has expanded her question. So GIS, she means GIS as Geographic Information System. It works for spatial data collection, and RS is remote sensing, which is used to
Okay, 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 no,
acquisition
no, no, that's
special,
now.
yeah,
Yeah.
special, especially for disasters.
Yeah. So remote sensing means the sensory data, right, coming out of some sensors, right? So we need to use some kind of a machine learning model, which we have like a convolutional neural network to
Right.
uh, to make sense of that sensory data. And your GIS data could be then also mined by using some ANN or artificial neural network or RNN, or it all depends. Like, if you want to really see which particular specific AIML model would be required. Suppose if you want to do sequential modeling, like time series modeling, you want to build on the historical time series, and you see that some of those patterns will be repeated in the future, then RNN, recurrent neural network, would be one. If you don't want to build a time series effect, then ANN or multi-layer perceptron would be one, right? If you want to pre-process the data, which is imagery data, satellite images, or some signals, or some form of non-conventional data, then convolutional neural network would be first processing that data and then feeding into either a ANN or RNN, right? So there are multiple different models that need to be employed to fully build a maybe a universal model at for the climate risk, right?
Yeah, absolutely. All right. So I hope that answers your question. The next question is from Meet again. So the question is that for someone without GARP SCR certificate, would it be good to take up IIQF certification on climate risk modeling? Yes, Meet, that is the specific reason of conducting this courses when we launch that, right? So essentially, like in all the courses that we do, I mean, when we launch this course, this would be a course to prepare you absolutely to work in the field of climate risk modeling, right? So yes, I mean, definitely, if somebody wants to enter into this industry, this would be a course which will give you a deep knowledge and prepare you for those kind of roles. There's no doubt about it. All right, going to the next question, which is from Swanand, and his question is: thanks for detailed session. Thanks, Swanand, for the kind words. Do investors, lenders demand higher rates of returns when lending to coastal projects with some environmental risk added in the modeling is to determine I mean, added in, and the modeling is to determine this risk premium?
Yes, absolutely. But things have changed maybe in last decade or so. That previously it was that most of these lenders or investors were demanding, or financiers were demanding, a higher risk premia. But now, seeing the magnitude and intensity of the crisis, they are now cutting their exposure to these coastal areas or coastal belts or these riverine areas, right? So what it means is that they are themselves have the pressure from the regulators to transition away, right, or discourage the financing or investing to such sectors or industries which are any which way found to be potentially vulnerable to climate risk,
Right.
right? Right. So the risk appetite over the time uh, will grow to marginal, right? Will decline to marginal, right? And with that marginal risk appetite, any which way, any vulnerable sectors or industries would not be financed.
Correct.
Yeah.
Right. So I hope that answers your question. Going to the next question is from Aishwarya. So she has asked like how can we or how we can implement machine learning on agricultural risk and also on agri data analytics. Would you like to take that question?
Yeah. So specifically, there are certain research papers which are devoted to crop yield. There are certain research papers from the perspective of agrarian economy. There are certain research papers which are devoted to the soil degradation, right? There are certain research papers which are related to maybe the surface flooding and its impact on devastation of agriculture produce, right, and supply chain disruptions. There are certain maybe research papers which specifically look at these coastal areas or sea ocean near ocean areas which through some maybe geographical mapping they specifically focus their energy to those areas like growing spices near to ocean or right. So what are maybe the downsides of these coastal areas which are any which way with rising sea levels are going under the water, right? And if there's an agriculture produce any particular agrarian commodity or agriculture commodity is produced or is cultivated in those areas, right, then or is dependent, and then there's certain things which are very much focused on fishery, right,
Right.
and oceanology, right, right, how it is impacting the environmental risk is impacting fishery and oceanology because that is also common farming, right, as a farming produce, right. So all these different risk papers talks about using AIML techniques, right? Uh, n- Not all talk about using building deep neural network, but there are multiple. Like for classification, many of these risk papers use a random forest, right, to classify the areas which are more vulnerable than the others, right. So for non-linear classification, they use support vector machines as well, and sometimes they do typical lasso ridge regression as well to
Right.
attribute the risk factors, right, what are the risk factors in specific areas. So there are a lot of research happening in this agriculture or agrarian economy, right, using machine learning.
Wonderful. Great. So I hope that answers your question. So there are like last two questions we would be taking up quickly because we have already extended the time a bit. A lot of questions were there. So the next question is from Susant, and he has asked, how important is it to use GIS and remote sensing technology in this field? So I think you have already answered that question to a great extent. I mean, anything you would like to add?
Yeah, so Shushan, just one thing, machine learning, right, models, just be wary of one thing, that the more data you present to them, right, the better you would expect out of them, right.
Right.
So the remote sensing data and this GIS data is something which brings in critical measurements on climate risk, weather variations, and earth ecological changes, right? And that would be a key data set for machine learning models. And also, given the capability of machine learning models to process any or form of data, whether conventional or unconventional, like image or video data as well, even signal data as well, we should not be shying away to use this data. After all, we are here to do the data mining, and that's why we are building machine learning capability in these areas, right? Because some of the data was unmined just because of the limitation of the previous earth system models, right, which could obviously be one of the uh, pivot in the direction of adopting AI/ML for such topics. Yeah.
Absolutely. Right. So it's a, I hope that answers your question, Sushant. So the last question is from YJ. It's a follow-up question. So first he has said that thank you for answering my question. You're welcome, YJ. And as you said, there are different government sections for climate risk. How can I work there, and what should be the way to there? Would you like to take that question?
Different government, sorry, sections.
Yeah, so you said there are different government sections for climate risk. How can I work there, and what should be the way to there?
So the climate risk as a topic over the next few years, as this policy is getting drafted, and you see that even our Prime Minister has on international protocol on climate change. I think it this time it happened in not in Paris or Copenhagen, wherever it happened. We also declared that by 2050 we would be carbon neutral, right? So in the government department, there's a policy in works, ESG norms in works. There's a regulatory teething framework which is currently getting developed, and I'm no surprise that in coming times, one of the most prominent ministry would be environmental ministry, who will decide the future course of sustainability. And in government departments as well, in across various departments, even the most of the premier institutes like IIMs, right, they would definitely be starting over the course of time some dedicated course on climate risk, right? So there's ample of opportunity, ample of such jobs coming, besides the foreign banks and foreign institutions, or maybe some of these non-governmental organizations. There's a lot of research work which is there in Indian non Indian governmental organizations as well, for which people will be hired who have these specific skill set. But I'm clearly, I don't have clear right view on that, which particular jobs in the government sector are currently available where such data science, machine learning, AI in the context of climate risk is that kind of skill set is in demand, and they are looking for that. Maybe I am not well close to the topic. Yeah.
Right. So with that, actually, we have come to the end of the session. Whatever questions are remaining, those are like almost a repeat. So, I mean, I believe we have taken up all the questions. First of all, thanks once again, Sanjay, for the engrossing session, and more importantly, for your patience in answering all the questions. And to the participants, thank you for taking your time out on a Sunday and joining us for this session. Thanks for your insightful interactions, questions. I hope you found the session to be interactive and useful. So, I mean, we look forward to have you with us in all our future webinars. As you know, I mean, we conduct this webinar sessions on various important topics in our area in regular intervals. So, keep track of us in our website, in our social media pages, and in our all links. We'll also intimate you for all future webinars. See you again in the next webinar. So, with that, let's conclude the session for the day. Thank you.
Thanks,
Thank you,
everyone.
Sanjay.
Thanks. Yeah. Thanks for your active participation. Looking forward to it more and more. Right. Thanks.
Thank you. Thank you.